Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest, but I've been following her work now for a couple months. I think I first saw her over on Adam Taggart when he was on Wealthion, been following her other interviews, been following her on Twitter. She has excellent analysis on the real estate market. She's been working in real estate, I think, for well over a decade now. Melody Wright, thank you for joining me.
Thank you so much for having me.
So, Melody, we're recording this interview on Thursday, January 11th, 2024. I want you to talk about your background first in real estate because did you start working during the 2008 financial crisis, or were you working in real estate and banks and mortgage before that?
I started in 2006, in September 2006, just as basically at the top. I attended a party where there was a life-sized Lego house and balloons coming from the ceiling because my company had just, made GM a lot of money and they were celebrating. But quickly after they got purchased by Cerberus, and Cerberus wanted a purchase price adjustment because they were kind of seeing the writing on the wall there at the end of 2006. And so in many ways, we sort of led all the write-downs. We sort of led the drama because of that acquisition, which got very interesting later on when we became a bank holding company and in order to get to be eligible for TARP funds. So started right before the crash, basically.
That was a crazy time. I mean, I was a stockbroker in 2007 and 2008 and part of 2009. It was absolutely wild time. I mean, there was so much misinformation and lies. I remember there was tons of experts like Peter Schiff and others that were predicting the housing bubble was going to crash, and the thing just went on and on for quite a few years longer than many people thought.
Yeah, and I think that's what we're seeing today as well. But absolutely, I remember like you was absolutely crazy time. 2009, 185 days straight in the office. We floated Jimmy John's basically, reviewing strategic alternatives, distress asset sales, write-downs of our mortgage servicing right portfolio. I mean, it was just absolute chaos. But like you, sort of we were listening to mainstream media. I was a lot younger back then. And we basically, they told us everything was going to be fine. And so the executives where I worked absolutely believed that things were going to turn around any day. And they believed that pretty much all the way up through the 2010 refinance boom. And then ultimately, finally in 2012, the writing was just on the wall as the banks kind of got into trouble for the mortgage servicing errors through the consent orders and the AG settlement. And my company ultimately filed bankruptcy in 2013. I'm sorry, we filed in 2012. That's correct. Sorry.
So your company was not one of the companies that was saved or rolled up into a large bank. And then from what I remember, there was a ton of rules changes, and wasn't the Federal Reserve Bank and the U.S. federal government and the other housing agencies, FHA and some of the other ones, Fannie Mae, Freddie Mac, weren't they handing out artificially cheap loans almost for free for cheap capital to like BlackRock and hedge funds and institutional investors and some of these private equity groups to go buy entire houses of real estate?
Yeah, in terms of the funding, I'm not 100% sure. I've heard things like that. I don't know that we know everything that happened, but I will definitely tell you, because I was at the auctions, that the GSEs were very happy to have the institutional investors come in, in 2012 and start buying up all those properties at auction. And, they set it up where it could work very nicely. If you went to one of the big auctions in California that used to be on the, steps of the courthouse, they were, during that time, they were held in hotel ballrooms. It was like walking into a casino in Las Vegas, and you could even get financing on the floor there. So, the GSEs definitely pushed those properties into the hands of Wall Street.
And my friend Carol Roth just wrote a book on this in the last 12 months. I think institutional investors, private equity, BlackRock, those types, and hedge funds, I think they own around 25% of all single family homes now, which is shocking. And the change has just been the last 10 or 15 years.
Yeah, I think it's a little bit less than that. You hear a whole bunch of different numbers. It's hard to know for sure. But they definitely are big players in the market. I think it's probably more around the 17% mark, but I can check and tell you for sure later.
Well, it's still a large number. And then you have a lot of
Correct.
foreign pension funds, and then you have a lot of
Yes,
Chinese investors that have bought. So there's been a lot of competition with regular people that have tried to go out and buy their first home. So, like the average person there, who young adult like myself, who would have been able to buy a starter home a couple decades
that's right.
ago, you're just getting outbid.
100%. And that, that just persisted up through the COVID boom until the institutionals kind of, stepped back in 21. And then you had a lot of smaller mom and pop investors come in with the same idea, and use leverage to do it.
And I hadn't even checked the S&P Home Builders ETF, which is the XHB. That's at an all-time high again. It's at 95.23. I was just shocked when I looked at it a couple of minutes ago.
It's very shocking, but I went on the road out in February to look at these new home sites because I could, I was listening to people like Ivy Zillman, whom I'm a huge fan, and others talking about this new home inventory. And with everything else that I knew, the 15 million vacant homes we have in this country, the fact that Wall Street had bought up so much of that long-term rental and turned it into for rent, the build for rent, all of this in the multifamily building that's the highest since the 70s. And I think when we're all said and done, it'll be higher than that. I knew that there was just something rotten in the state of Denmark. And so I hit the road in February and was able to go out and to physically look at these new build sites, and the inventory that's out there is not being represented anywhere that we look on MLS listing sites or things of that nature. And the permits themselves, I think it can be very difficult to get a true understanding because there's so much in progress and not completed. But at the same time as well, those counties where those permits are recorded or pulled for recording, they often have very serious delays. And in COVID, that was just exacerbated. So I think we're still in the fog of war. I think we have no idea how much inventory is actually out there, but it's way more than most people understand. And then on top of the fact that it's not coming in, we're not seeing it on the listing sites. One thing that's absolutely happened with the advent of social media is that you would hear stories about these brokers contracting with local builders for Airbnb specifically, and they'd put these homes on Facebook and they'd be gone in an hour, and that never made it to a listing site. So you have a lot of people out there, especially the establishment media, screaming about a shortage in inventory when in reality we just don't have good data, and it's kind of been pushed out into a private marketplace because, as I'm sure you know, the GSEs make up a huge portion of the housing market now. That's Fannie, Freddie, as well as, FHA, VA. But we have these things called private note sales that really nobody has been able to really get a sense of. And that's something I'm working on right now and diving deep into. And this is where people are transacting in a lot of these small mom and pop, some of them not so small, hundreds of homes are transacting outside of the regular marketplace. And so, I firmly believe we're in the fog of war, and there's a vested interest and people saying that we have an inventory shortage. Yesterday, Senator Warren came out with a tweet saying we were missing 7 million homes. I responded and said, if you started prosecuting non-owner occupancy fraud, I bet you'd find a lot of your missing homes because everybody became a landlord, very similar in many ways to the Great Depression. Everyone wanted to get this passive income. They wanted to be able to, make a living outside of corporate America, where the social contract has really been broken, in the last several years, especially with COVID, when you just had layoffs. They didn't care how long you worked there. And so I think I understand why everybody wanted to pile into short-term rental or long-term rental. But in reality, we are now in an oversaturated situation from both a short-term rental and long-term rental perspective, because people went in and they contracted these built for rents like American Homes for Rent. They specifically hired builders to build these ugly boxes to rent out, which in American Homes for Rent has become a net seller of those now. So they were originally pegged for, long-term rental, and now they're being sold as single family homes. But a lot of them won't go because you're going to have a lot more options with a multifamily closer to the city in many cases. And with all the rent specials, we know that renting is cheaper in almost every city I think, Redfin says there's about 4 cities left where that's not the case. Zelman just did a recent, really great proprietary study, and she came up with about 4 cities as well, where it's cheaper to own rather than rent. And so, what's going to happen, because a lot of our millennials have given up on this dream of home ownership after what's transpired over the last several years, is that you're going to have the for rent space competing with the existing home sales as well as the new home sales.
We just have a distorted market. I would blame a lot of it on the Federal Reserve Bank and the other government agencies, especially about 15 years of zero interest rate policy, the quantitative easing program. And then as an after effect, a knock-on effect, not the cause, that led to what you said there, that rental property boom. It was the Airbnb effect, because Airbnb at some point, and I'm friends with Amy Nixon too, it was supposed to be cheaper, a cheaper alternative than a hotel. And then
yeah, definitely. That's how it started.
yeah, and then it turned into a bubble where it was more money to rent an Airbnb than a hotel, and you get all these other added benefits from staying at a hotel now. So like the consumer is going to look at that when they go on vacation or travel now. But now with interest rates where they are, I mean, I had to block real estate agents in other areas for suggesting that people were going to run the math and that they can't afford the mortgage payments, and they don't want to sell their existing home if they locked in a cheaper mortgage 6, 7, 8 years ago at 3 or 4%.
Yeah, and Fannie Mae just did a study on that, and they came up. They actually admitted to surprising themselves and saying that much fewer people than they expected were planning to stay in their home longer due to higher rates. And so, yes, there were some, but just as many said it was because they either liked where they lived or because of home prices. And I think what a lot of people forget is that it's not just the higher rates. Everything that I saw out on the road, is north of 400, and the median income in this country is around $79,000. Most people with all the expenses, including taxes and insurance, cannot afford that. And so, it's definitely distorted, and we have an exaggerated sense of how rich people are in this country. And, there is definitely a reckoning coming. I think, we all have to be cognizant we're in an election year. And so again, just, similar to the last time, this could grind its way, and this could take a very long time.
I think the average mortgage payments for people locked in at a much cheaper rate, aren't they below $4,000 a month? And then now, if you were going to get a mortgage now, put 20% down and get a mortgage, even if you have a perfect credit score, it's over $6,500 a month in the mortgage payment, right?
It's insane. And, nobody puts down 20% anymore. The average, according to Forbes, is 14.4%. But most people right now that are getting mortgages that are not the top 10%, they're using these low down payment programs like FHA and VA and even Fannie and Freddie. And then on top of that, they're using down payment assistance programs. And so these are folks that unfortunately, probably can't afford a home. And, one emergency, one sort of leak away from default. And, and that's concerning because it means that it's jeopardizing their future ability to own a home.
It sounds like people are still trying to speculate. They're speculating that the home prices will still continue to go up. There's a lot of people, even the ones that are locking in mortgages at these rates, they still expect home prices to continue on an upward trajectory.
Absolutely. People absolutely believe that. Home prices only go up is what they say often. And those same people say date the rate. And I think we're going to remember all of these things. I mean, home prices don't always go up. We have a significant history where that is not true. So, but absolutely, folks are out there shilling their narratives, and it's like the Upton Sinclair or Sinclair Lewis. I can't remember but if your paycheck depends upon it, then you're gonna say whatever you need to say.
I think it was Upton Sinclair, but
Yeah,
it might have been a pen name. I don't know if that was his real name or his writing name. But the governments would love if real estate prices kept going up and up and up, because then at the federal level, that would be higher capital gains taxes. I think Biden blocked the 1031 tax exchange. I think each time now you have to pay taxes. And then the state and local governments, the property value, reassessing, reappraising the property value. I mean, in my area, every time a new home is built in the neighborhood, they want to reappraise the property value and raise the property taxes. So the governments would love that if home prices kept going up from a tax standpoint.
Yeah, they're not gonna love it when they have to take them to tax sale. So, the local governments got very wealthy last time around because the banks had so much on their balance sheet, and these were GSE loans where you have to advance money out to the counties. You have to pay taxes and insurance, regardless if that borrower is in default. You have to mow the grass. You have to take care of those properties. You have to pay for any vacant property registration. With a city, you have to pay code violations. But since so many, over 30% and way more in many markets were all cash sales, and I'm putting that in air quotes, these aren't on a typical bank or even the non-bank balance sheet. They're out there through these private note sales. And what's going to happen, especially in places like Texas, is when you don't pay your taxes, and this happened to a lot of people last year, you get those delinquency notices, and then the county can take you to foreclosure sale. And in Texas specifically, it's a very short foreclosure state. And so the counties, I believe, and again, I'm looking at a very long time horizon here. I want kind of everyone to understand that, but the counties are going to come under significant stress because they have no expertise in managing this. And it's going to be a huge burden when places, especially in Florida, I cannot even describe the inventory there, but it's almost as bad in Texas when they are having to take all of these to foreclosure sale. So they love it now because they made out like bandits in the previous cycle. It's not going to be the same in this future cycle.
Plus, government budgets went up. So as property taxes increased enormously over the last couple of decades, government budgets correspondingly increased. And I think a lot of these state and local governments, the counties and cities, enormous percentage of the government budget is reliant on property tax assumptions that people will pay, that there won't be any defaults or any problems with people paying the property taxes.
Right. Just like we rely on, people paying their taxes. And I think people have been unpleasantly surprised at a federal level at how many people aren't paying or behind.
Well, post 2008, my argument is one of the major reasons the quantitative easing programs happened was because there was drops in the federal government tax receipts, and also the state and local government level. I mean, the Fed was buying municipal bonds in 2008, 2020. So it was to fill the tax revenue gap when there was a recession or asset prices crashed.
Mm-hmm.
So I want to ask you about this discrepancy that you've been talking about a lot of different details. Does Wall Street intentionally use bad data? What type of real estate data is Wall Street using?
Well, I think most people just look at the housing market. When you're at that institutional level, they're only looking at home prices, and they're looking at inventory. Although I can tell you, inventory played a little bit of part, like late in the cycle last time as well. There were definitely people saying we had an inventory shortage. I don't think as loudly as they are now. But most people just look at home prices. I mean, honestly, when you're I remember, kind of one of my jobs was I was in FP&A, or financial planning and analysis, but I supported our investor relations team. And so I was responsible for all the messaging around the financial information in our earnings deck. And honestly, the only thing that we ever talked about was home prices. And so people really focused on that. And then, if you kind of branch out, you look at sales, you look at listings, but listings for sale, for instance, that the Fed uses or tracks, that comes from realtor.com, which, is owned by the same parent as the Wall Street Journal. And, realtor.com has admitted to me directly that they aren't connected to all the listing sites, all the MLS. They are connected to the most out of every listing site out there. But there's this thing where, as a local multiple listing site or MLS, you choose whether you want to syndicate to a larger listing site like Zillow, Realtor, et cetera. And when I asked realtor.com specifically if they knew or tracked the percentage of people that didn't syndicate, or, what was that percentage of inventory, they didn't answer the first time. I re-clarified the question, and they did not answer it the second time. And so just from that example, you can see that there's a lot of inventory that we probably don't know about. And then, in my Substack, I did some case studies for a local community in Florida when I was there for a couple of months, where you went to this one big 55 plus community, where if you went to the MLS, you could see maybe 9 properties for sale. But if you went to that community's website, there were over 100 properties for sale. And then right around the corner was what looked to be like a built for rent site. And that there was just probably one card up on the listing site, one, theoretically one property for rent. In reality, there were probably 50 houses in that subdivision. And so we just have no idea what's out there. And I think that even people that track the builders, they track a lot of the nationals. They may have some of the larger regionals and maybe one large local, but they don't track the smaller builders. And I've talked to many builders out there that say, nobody captures me in their survey. And everybody needs to understand that, I think people have branched out into tracking new sales, existing home sales, things like that. But in that new home sales information and, permits, et cetera, that's a survey. It's a survey of construction. And I'm sure you're aware that, many people have talked about the efficacy of those surveys has declined significantly since COVID and participation in those. So again, I don't know the numbers out there, but I would say we have no idea what's really out there. And the only way you can tell is by physically visiting these sites, which is, what I've been trying to do over the past year.
It sounds like there's a business opportunity for someone. I don't know if it's you or maybe someone who wants to fund you to go out there and create a better database, more accurate, boots on the ground, maybe bottom up instead of top down than the MLS.
Yeah, and I think that a lot of people are trying to do that, and they're trying to scrape data from all the broker sites, et cetera, et cetera. But the problem is that there's over 3,000 counties in this country, and really the only way to understand what transactions look like is to go to the county records. The problem is that you've got these county recording offices that still use fax machines and pencils. I mean, they are so not technologically advanced. And so it's very difficult to get that data. And, you have to either be directly connected to the county or you have to kind of scrape and really know what you're doing. And there's a lot of new entrants. Big tech is definitely trying to get into this space, but they're all severely constricted due to their lack of knowledge around the industry. And you can kind of see it from some of the new entrants.
So I've listened to interviews with Ivy Zellman and some other people, yourself included, and they've talked about how the publicly traded home builders have been, I guess, buying points or subsidizing people's mortgages. Yeah. Why do you think they would do that? And are those home builders still profitable if they're doing that?
Well, so they have to do it because you got to think about them like, when we talk about inventory in manufacturing, they've made a promise to the street of how many they're going to deliver and then how many they're going to sell. And so they have to sell these things. And in order to do that, they're going to do the buy downs. And, this was something when I got back from the road, I spent a lot of time looking at builder balance sheets. I could see they were kind of trying to hide the cost and what's called their SG&A. But, it's their margins are definitely coming down. Despite what everybody says, in mainstream media, a lot of them are actually struggling. You like take Lennar's earnings recently. Everyone in mainstream media completely glossed over their huge loss in multifamily year over year variance, way over 100%. And now they're trying to offload a huge multifamily portfolio. So it's almost like the builders can do no wrong right now. And I think that's being pushed by the media to kind of prop up and offer some kind of semi-affordable alternative. And so, last time Lennar got bailed out by the government through a tax program, I'm fairly certain the builders will get bailed out again. And, what I foresee is likely the government will pick some winners out of the big nationals and say, okay, we will subsidize your write-downs because they are absolutely going to have to take write-downs if you pivot to affordable housing. And so I think that's something we're going to see in the next couple of years as well. But it's unbelievable that these builders are at an all-time high. But I will tell you, in the last cycle, we had a very big builder group at my company, and we were a top 5 servicer and originator. And the builders were the last ones to face reality. They kind of said to us, hey, we play golf with these guys every day. They're fine. They're fully capitalized. They have plenty of liquidity. And then overnight, that changes. And you may know this just because of your experience, but you may think you have a strong balance sheet, but one sort of, bad turn and you start tripping covenants and things just go sideways very fast. And one thing that people don't understand about the builders is they don't do fair market value for these communities until they reach a below 10% margin. They're just doing cost modeling. And so if these communities are out there and they're not being sold, then they don't have to actually fair market value. And that's a lot
Yeah.
of what I saw on the road. I mean, there were just these empty communities, priced at north of 400, a lot of them way over that, especially in places like Austin.
Wait a second. So by cost modeling, do you mean this is like a kind of what a bank does? It's marked to model. So they're saying
Correct.
we're going to build this home,
Mhm.
hypothetical. We're going to build this home and we're going to probably be able to sell it at current market values, what, 400,000 or 450. So they're just projecting. They haven't actually built the home and they haven't actually sold the home at that price.
Right. Or they may have built it, but they have not completed it. And they haven't filed that final certificate of occupancy. And honestly, what I had to, I think that, then I think that people at these local sites have a way better understanding of what's really happening, but that information is not making it up to corporate.
I would guess not. I mean, there's a lot of accounting gimmickry that's gray area.
Yes.
I mean, most publicly traded companies get away with non-GAAP or at least the gray area. I mean, a lot of the tech companies, they were doing adjusted EBITDA. I mean, that stuff. I'm sure the home
Hmm.
builders are involved in
Yes.
that stuff. I'm actually friends with a short seller. He was short the home builders. You were talking about like the tax credits and stuff. I mean, those rules were
Hmm.
changed a lot for the publicly traded home builders. I mean, they were basically going to go bankrupt back in
Yes.
2008, 2009, and then
Yes.
Congress just changed the rules for them.
That's correct, which is a bailout to me. So, and I don't think a lot of people remember that. And each of these national builders, they do their, gospel singing about their balance sheet and how they learn their lessons. And, I know a lot of these people and I believed it for a bit until I went on the road. And you only have to be on the road for about 15 minutes before you realize that it's absolutely not true.
So I want to transition now to commercial real estate. Sounds like there are problems in residential real estate. Would you say that the problems in commercial real estate are even larger than residential real estate?
I think the scale is larger. But in terms of the aftermath, I think it's going to be as impactful. But I think these are inextricably linked. These two, commercial and residential. So I I I think multifamily is going to be a bloodbath. Over a year ago, I was saying multifamily is going to give office a run for its money, and that's starting to shape up, even though we haven't even really begun to see the true scale of the write downs that are coming. Because unlike some people, having seen what I've seen out there, I know 100% this isn't just about work from home. This is about the fact that we overbuilt for years. So these two things combined means that commercial, if we are able to get true price discovery without some sort of, facility coming in at par for these things or extend and pretend. I mean, this is going to wreck companies. This is going to, wreck a lot of balance sheets if we get true discovery. So for the next year, it will definitely be a much bigger component than residential.
Okay, for our listeners out there, multifamily, is that like those apartment complexes that some of these big shot real estate investors buy for cash flow for rental property income?
That's correct. Yep.
Okay, so like the average rental property investor might buy one rental property. If you're a big shot real estate investor, then you're going to buy entire buildings for rental property income.
Well, and unfortunately, what happened over this last cycle is you got a lot of new entrants into this space who it was a very unsophisticated investor who bought probably a class B multifamily. There were all kinds of people selling that on YouTube. They rehabbed it, but now they're coming into competition with these larger operators and these massive apartment buildings that are able to offer these significant rent specials, because very much like the builders, what these multifamily operators are doing is offering, your first 3 months free or something like that. So it's going to be ugly out there, because you had just as in every sort of cycle like this, you just had a lot of unsophisticated players get involved. And I think it was worse because of social media. Back in the day, you might go to a conference, but now all you have to do is a quick Google search and somebody's going to tell you in how to make $1 million, when in reality, you're probably never going to make any money.
My best friend's a real estate agent here in the DC metro area at one of the largest firms, and we've had dinner with some of these developers. I mean, the developers, some of them just got like absolutely ridiculous with their borrowing, and a lot of it's because of the Fed and subsidizing interest rates so cheap. So these developers, whether it was commercial or single family homes, multifamily, I mean, I would call it the last 15, 20 years, as soon as the Fed lowered rates to zero, I would call it a tear down boom, especially in my area, in the DC metro area. I mean, there's just been a ton of gentrification and a tear down boom because of the cheap rates. So they bought these really old single family homes and they went and built a McMansion. They bought like
Right.
these 1 floor strip malls and they went and built like a 10 floor mixed use with a couple floors that were retail or restaurants and in luxury condos. So there's just been a ton of that, I would gather, all over the United States.
Yes, absolutely. It is all over. And for anyone that says it's not in my backyard, you can go to places in the Northeast that everybody thinks is immune, and you can find these pockets. They are everywhere. And if you think they're not, I can give you some websites to take a look, because everybody wanted to get in on the grift. And I can understand the motivation. Wages have not been rising over that time period you just mentioned. It has felt like a total grind to those of us, in corporate America, working every day, feeling like we can't get ahead. While others, the asset holders, obviously have gotten richer and richer. And so I understand why people wanted to get in and wanted to get passive income, but the reality of the situation is much different.
Well, it's also the developers taking advantage of the cheap rates and the investors who couldn't get a 5% return on short-term use treasuries or 4.5 until recently, or money market funds. So while the Fed kept rates that cheap, I mean, the developers, if you were a real estate developer to go tear down single family homes and build a McMansion, or go and build luxury condos and mixed use buildings with retail restaurants on a floor or two, I mean, the capital available was just immense. Some of those developers cashed out. A lot of them got greedy, and they have overbuilt all across the United States. I mean, they're at one point near the Washington Nationals ballpark here. I think there was 20 construction cranes. There was a picture from the
Wow.
outfield. There was just 20 jumbo construction cranes building luxury condos all over the place.
Thank you for that, because I will be there actually in the next 2 weeks. I'm
Oh,
going to be doing some site visits. Yeah.
oh, we can meet up. Yeah, we can have dinner or something if you want, for sure.
Excellent. Yeah. So I was just going to say, I was listening to your interview with Dave Cullum, and he mentioned the price of time. And I think, there's a quote in that book that says, John Bull can stand about anything but 2% return. So, I agree with you completely that people were searching for yield, and they did all kinds of crazy things.
So for commercial real estate, do you think then that who are going to be the bag holders in this cycle, or do you think that the banks are going to play similar games to what happened with your company and single family homes in 2005, 2006, and 2007?
Yeah, I'd love to say I think we're going to be the bag holders. Unfortunately, I mean, that's the way it looks now, unless things go very differently. I think that it comes back to our government will bail them out to some extent, and that they, of course, will pick the winners and losers. We take this last auction on the signature assets, from the failed bank. And Brookfield has filed a complaint saying that the FDIC absolutely did not choose the highest bidder. And so I think the government will pick winners and losers, but the taxpayers will probably ultimately be on the hook.
Wait, so you're saying Brookfield, that's a commercial real estate company, and you're saying the FDIC uh, chose like one of their largest banking friends then instead?
Correct. and Brookfield's filed a complaint. And it's crazy to me that this story is not everywhere. I mean, but yeah, I posted it probably about 2 weeks ago on Twitter.
Did you see that one of the largest malls here in Loudoun County, which is one of the highest average median family incomes, fastest growing counties in the entire United States? It's in Northern Virginia. And the mall there, I think it was appraised around 300 million, and the insurance company quietly just sold it, I think, for 85% less. That was holding the property.
Yeah, I think I did see that one. There's so many these days now, there's a new one every day, but I do recall that.
Yeah,
It's crazy.
I wonder if they actually mark to market those losses. I mean, they took that's an enormous loss. I'm wondering if they actually put it on their balance sheet.
It doesn't feel like it. Otherwise, we would be seeing different things, right? And I remember, so one thing I do remember in my company, because of Cerberus wanting a purchase price adjustment and us having to reevaluate our assets, we led the write downs. We were before Chase, Bank of America, et cetera, and we led it by about 8 months. It was a lot. And so I really think that I was hopeful that this signature auction would actually start to incorporate or force price discovery. And I think in some ways it has, but we're not hearing about it. Even after SVB, you heard that Chase was trying to quietly offload a lot of these assets for maybe 70 cents on the dollar, but we're not hearing about it in the public. I think that they feed us these stories like the one you just told me about the mall to kind of, quell our appetite. But in reality, I think there's so much more of this happening, and they're doing off balance sheet tricks to really hide those losses.
I speak to bankers off the record, and the banks are telling me basically this is 2005, 2006, and 2007 all over again with the accounting gimmickry. No one is marking to market yet. So we're talking
Right.
about all the major cities and metro areas. You see the headline stories, but the actual financial entities, so like the
That's
pension
right.
funds, the insurance companies, the banks, they're not taking the losses. They're quietly either they're trying to renegotiate a lease, saying like, well, what type of lease can you pay so you don't leave? They need the cash flow. And I think over the summer they changed the bankruptcy laws so there what a definition of a default is, which is just absolutely ridiculous.
Wow. Yeah, I didn't know about that, about the bankruptcy laws. I'll look into that. But I agree, as I was kind of saying, because I was working very closely with both Cerberus and the CFO, I took my asset sales schedule with me everywhere. And we were selling a lot of distressed stuff that wasn't no one actually knew about. And that's the thing when you go into these auctions or you go into these talks around these deals, you can keep it pretty quiet. And so again, that's why we were very, very, very early. But so I think we're a ways away from true mark to market and true fair value.
If they do mark to market, I think there could be bankruptcies and bailouts, or forced mergers and
Absolutely.
acquisitions, or maybe the government creates like a new government sponsored enterprise company, kind of a quote unquote bad bank, and sticks it in there like the 1980s savings and loan crisis.
Well, I argued a year ago, I did a spaces with Michael Gaia, and I believe that Fannie and Freddie are going to get into, the asset disposition business. And I think they'll partner with BlackRock, who was there last time. I spent many hours talking to them on the phone and trying to explain them to what, face value meant. But I think absolutely what the government's going to get way involved in disposing of these assets, managing these assets, and kind of taking them on to their balance sheets, in my opinion.
So as we wrap up here, I'm sure we could talk about more and more details. It's just very disconcerting. I don't think we're going to see honest accounting for a while, if ever. And then the government, unfortunately, Congress or the Fed or one of these government agencies, alphabet soup, there'll be a new liquidity program or TARP or bailout funds. For young adults out there, though, what should they be doing here if they're looking to buy a single family home or go buy a condo, or someone's looking to refinance? Should they just hold cash and wait then?
Yeah, I would be building cash if at all possible. And I would wait. And everybody's situation is very different. And so I don't like to give blanket advice. But if you are going to have to take leverage to buy a home, then wait. And if not, it's a bit of a different story and you can negotiate things. And I do think there's going to be opportunities in certain markets. That's why I track local markets. But right now, it is just too volatile. My recommendation, not knowing anyone's specific situation, would be get all of that return on your cash right now as much as possible and build that down payment for when the time is right.
Yeah, I think that's good. If people are actually getting a reasonable interest rate at this point right now, especially relative to stocks, because the stock market is very, very inflated. And well,
Crazy.
who knows how, especially the home builders index. I mean, I hadn't even checked that until about an hour ago. It's nuts.
It's nuts. It's
Well,
absolutely nuts.
Well, I hear stories because my best friend's a real estate agent in DC metro area, and he has people. Obviously, there's still people here who are making well over $100,000, and they want to either trade up for a home or trade up for a condo. And they locked in a mortgage years ago, and it was around a little over $4,000 a month. But now, if they want to get a mortgage on a larger property, I think it's like well over $6,500 a month, and that's almost all their monthly income. So obviously, they're not going to do that.
Yeah, would not recommend that at all.
Well, not unless you can go and wire over $1 million in cash, which is what was happening for a long time in this area. I'm not sure how much it's happening now, but it was for a while.
Yeah, I think it's still happening to some degree, just like you say, not at the scale that it was, but I think there's still plenty of wealth management groups that want to give you that loan that so you can bid in those markets. And I think we're going to see a lot of that distress. It's going to take some time, but I think a lot of your wealth management, I call it the super prime, are coming under stress, and they're going to come under a lot more stress in the next year.
So for your Substack, are you covering what's going on in Florida? Are you going to different markets and visiting these?
Yeah. So, yeah, if you follow me and you read my stuff, I believe Florida is where we should all be watching right now. Just like last time, it's going to be the epicenter and it's going to set the national tone. And I think things are going to get fairly disorderly there this spring, especially in certain markets like Fort Lauderdale. But I go all over the country. I've been to many cities and I detail that in my Substack. Most recently, I was out in Denver and did a deep dive on that last week.
Excellent. And let me know when you're in Northern Virginia. I mean, this area is crazy. There was a ton of boom here. I remember in 2008, Loudoun County, Dulles Town, a lot of the area, Dulles and Loudoun, it was undeveloped. It stopped during the housing boom. That area is fully built out now. There's luxury condos and fancy townhouses that are selling for $1 million or more all over the place.
Yeah, I'm excited to go there. We've got a couple of locations picked out, but I will keep in touch. Maybe we can connect.
Well, what's the average person doesn't know this? There's 5 out of the 10 highest average median family income counties in the whole entire country in the DC metro area. So, I mean, there's a lot of money here. A lot of it's from the Cantillon effect, from corruption and all the money printing with the quantitative easing programs. And basically, every time the government budget increases, this area just gets richer. It siphons off more wealth for itself.
I believe you. Unfortunate, but I totally believe you. I used to live in New York City. We always kind of looked at DC as the cesspool. I know that's kind of funny, but
well, it's a rich cesspool now.
yeah.
We have
Yep.
nicer restaurants and luxury condos. It's a lot better than it was when I first moved here 22 years ago.
Well, I'll find out soon.